Accounting Standards Update 2016-09, Improvements to Employee Share-Based Payment Accounting, applies to all entities that issue share-based payment awards, such as stock options, to their employees. This update amends Topic 718, Compensation, Stock Compensation. It goes into effect this year for non-public companies and may be early adopted for 2017's financial statements. The update includes several improvements, including provisions regarding forfeitures and non-public companies, which we'll take a look at in this video. When an employee leaves a company before fully vesting in their share-based compensation award, they forfeit the right to the unvested portion of the award, which results in a forfeiture on the company's books. Under current GAAP, the amount of forfeitures has to be estimated at the grant date of the award, which is the day the company and the employee would have agreed to the terms of the share-based compensation arrangement. But the amendment allows for the company to make an optional accounting policy election to account for forfeitures when they actually occur. This would reduce the time the company needs to spend estimating and reevaluating each year, as well as the costs associated with these activities. When measuring the fair value of an option at its grant date, one of the factors taken into consideration is the option's expected term, or the amount of time expected to elapse before the option is exercised. The amendment allows non-public companies to use a practical expedient, or shortcut, for estimating the expected term for awards that meet certain conditions. If the award qualifies, a non-public company may estimate the expected term of the award as the midpoint between the requisite service period and the contractual term of the award, rather than estimating other factors that could affect the expected term. The update also confirms that when valuing share-based compensation awards that are classified as liabilities, non-public companies may make a one-time election to measure the awards using intrinsic value rather than fair value. The intrinsic value of a stock option is the amount by which the underlying stock price exceeds the exercise price of the option. Fair value uses several factors in its calculation, so intrinsic value may be simpler for a company to calculate. I'm Melissa Castro with Untracked Early.